as we think about how markets go through this, you've got a sort of three-step process you have to get through. The first is you have to see a policy response, and we've seen a huge policy response from both the monetary policy side, but also from the fiscal side. So that's sort of tick one. Tick two, we're seeing that sentiment and positioning are resetting at the moment. You've seen huge falls in asset markets. And as you go through sentiment and positioning indicators, things like the bull bear indicator, you can find signs that we're looking at a bottom at the moment. And number three then comes down to the cause of the problem, and that's the coronavirus. And we're seeing signs that maybe that is peaking. Even in the US, we've seen growth rates in the virus start to come down. So that gives us confidence that we can start to rebuild positions.
Just on the line, market moves have shaken out a lot of investors. Who has actually been selling here? Because it's been a hot debate around the desk over the last few weeks as to how much of what we've seen is basically algorithms that just continue to hit the sell button as a result of the way they've been programmed, as against medium to longer term investors who just, it seems, have sat back and said, we don't understand this, but we're not going to sell at a loss.
Well, I think the main place you've seen positioning clear out has been actually in the fixed income markets. If you look at the corporate bond market, that was really badly hit with outflows. I think you saw over 100 billion of outflows. It's been a huge shock to the fixed income markets, and one that they've struggled to deal with. The equity market has seen less of an outflow, but then the price has fallen not as much in relative terms as to say something like US investment grade, where we've seen really sort of outsized moves and almost dysfunction in that market at times. That has made it harder for people to come back into equities because valuations haven't maybe sunk as much as they did, or as much as they got used to in the last crisis. But it does mean that everything looks more attractive, and not every investor wants to sell at these sort of levels. We're also at quarter end, so you're starting to see rebalancing flows, which have also started to help the market and support it.
Oliver, I want to switch over to what you've been up to, notwithstanding the fact you've seen huge swings in that fixed income market. You flagged up to us that you like US dollar investment grade credit, and you've added exposure in some of these areas. I just want to pressure on that, because what we have seen, big names losing some of their status in an investment grade market. Ford, for instance, on the back of the pandemic. There have been others this year, Kraft Heinz, Macy's. How carefully do you need to pick your way through that investment grade sector? Because some companies were borderline anyway going into this pandemic, and some of them now risk become fallen angels. So what do you make of that potential risk of falling down the investment grade ladder?
Sure. So we saw in US investment grade credit spreads go above 350 basis points. That's a long way for them to move. And we felt that really did compensate us for the level of risk that we were taking on. Particularly as we had a lot of confidence that the US Federal Reserve would step in at some point to support credit markets in the way that the Bank of England and the European Central Bank have done previously and are doing now. So we had a lot of comfort that those very low valuations would essentially start to support the market at some point. We've also been buying through ETFs, and we were able to buy those actually at a discount to where the underlying bonds were trading. So it's really about price as much as anything. As much as we might have some sort of fundamental problems, if you can buy at a cheap valuation, it's a very good time to get in for particularly for longer term investors. But I think the US investment grade could and has recovered quite quickly in the short term.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.